Let's bring in Abby Yoder of J.P. Morgan Private Bank and CNBC contributor Malcolm Ethridge of Capital Area Planning. Brian Belsky also still with me. Welcome to all. Abby, we are at the third anniversary of this bull market. It's virtually the third anniversary of ChatGPT. No coincidence there. Where has it taken us, do you think, in terms of the market's reliance on that part of technology and what else is going on as we figure out if we're in for something more in the way of a pullback?
Well, I mean, there's no arguing that over the past couple of years, the biggest component of earnings growth in the S&P 500 has come from the Mag 7 and the tech-related names. Now, I think we're at a point where going into next year, because we've seen such increased development and increased efficiency and capabilities of this technology, that you start to see it broaden out in terms of, the sector use cases across the board. Financials standing out as a very, big proponent of using it and implementing it across the businesses, where you can start to see, the overall market therefore having, a better margin profile, right? Because you're in theory increasing revenues and decreasing costs, and therefore also garnering a higher multiple, because if you're a higher margin business, you get a higher multiple. So I think going forward, that's the bull case where you see that, broadening of use case for AI that extends beyond the current incumbents at the moment.
And is that kind of at the core of your market case for next year, or what else is going on in terms of the fundamental underlying economy that you're looking toward to kind of guide us into next year?
Well, I mean, it's certainly part of it. I think that, seeing in 2026, right, because 2026 is just a year away, seeing businesses institute and implement effectively AI over the next year, 12 to 18 months, it's going to be a slow grind, right? There's a J-curve experience in terms of that implementation. So I don't know that we're going to necessarily see all of that in 2026, but what we will see is a lot of growth positive policies coming through from the reconciliation bill that'll feed through to the rest of the economy. And if we get more clarity around tariffs, notwithstanding, what happened on Friday, I think you can also see more confidence from CEOs where they start to, invest more, and that could propel the economy faster too.
Malcolm, we've been in this deal maybe for a couple of years, probably as we get into the fourth quarter, of there being a case to be made that there will be a broadening out of earnings growth and a more kind of comprehensive increase in not only earnings, but just general growth, and maybe even have the market reward a broader group of companies. Are we in for that, or are we still, in your mind, driven by these big growth platforms?
Well, I would argue that the market has already started rewarding that the different diversification across the different sectors, still touching AI, right? So if we think about energy in the year that it's having, if we think about infrastructure in the year that it's having, all of those things are tangentially aligned with AI, but they're separate and apart in their respective sectors. And so that broadening is happening. It's just that the AI narrative is so loud and dominates everything else that that's the only thing that we can really focus on, it being the hyperscalers themselves. But I really think that the economy has diversified, or the market, I should say, has diversified what the winners are solely based on the AI narrative carrying everything else with it.
Well, I think you could say the market has determined what the winners will be in this build-out phase, right? I mean, it's sort of like, every time people get a sense that they've gotten their arms around exactly how big this investment phase is going to be, we get more of these partnership announcements, whether it's on the energy side or on the chip side, and all of a sudden, people have not been ambitious enough in their estimates. I just wonder if it's, the kind of thing where we can still deal with, maybe 60% of households struggling a little bit under a weaker labor market and still high inflation if those other things are going right.
Yeah, I share your concerns that we might be papering over a bigger problem. The fact that, the economy seems to be stalling, if not slowing. Every single month we get new data points. And the stock market itself tends to keep on going up and to the right. And so, yes, I take your point that the AI narrative, again, is so loud that it's kind of glossing over what could be a bigger deal underneath the surface. However, the question is really, the question we've really been asking for days and days is, how much longer can the AI bubble continue to expand, or the tech sector continue to go on this run that it's been, smacks of 1999 all over again and everything else? And the answer really is, how long will it take Sam Altman to get through all of the announcements that he and OpenAI can make with regard to the infrastructure investments that you're talking about, and how long do we have before we have to start to show productivity gains, as Abby was alluding to, where the AI now has started to make us more productive as companies, more productive as people, as employees, everything else, and whether or not that can filter through the rest of the economy to start the recovery underneath the surface, with the AI build-out being the cloud cover to get us there.
Yeah, I mean, we also probably have to wait for Sam Altman to come up with the money to meet all these commitments, but nobody seems to be too worried that that's going to be the case. And Brian, maybe we could focus it in a little bit on, we're going to start getting big bank earnings coming out. I guess if there were going to be significant issues in the underlying economy, they would show up in bank results. We haven't really seen that to this point. What are you expecting out of the financial sector?
No, I think the financials are going to continue to be very strong, especially the bigger banks with the multi-divisional lines of business that have wealth, commercial banking, the consumer, and of course the capital markets. Capital markets, again, had another great quarter in the third quarter for the majority of these banks. And remember, they're the ones that are trading, but really the real return on equity, return on invested capital with respect to these bigger banks are within the wealth platforms. The wealth people are the ones that are driving a lot of the growth. And so that's why the multi-divisional line of business banks, meaning the big banks, including Morgan Stanley, Goldman Sachs. And remember, Goldman Sachs has a massive wealth management business. Who would have thought that 20 years ago? But at the end of the day, that's what's really driving. And I think really the small banks, the really, really small banks with excessively clean balance sheets and great cash flow are going to do really well. That's why the mid-sized banks, what we used to call the regional banks, are going to suffer relative to the large and the small, because they can't compete with the scale of the big and they can't compete with the relationship base of the small, Michael. So I think you're going to see more consolidation there. And as we start to see deregulation, that's really what's going to drive this. But I do think earnings are broadening out across. If you take a look at earnings revisions for the small mid-cap sector, they're amazing. And their earnings continue to go up. So I think those companies are going to continue to be rewarded from that perspective, as well as we believe actually that 2025 is setting up Goldilocks in 2026 and 2027. So growth's going to be pretty good, maybe lower than this year, but lower growth doesn't mean negative growth. And I think that's a big, big misnomer right now, that people are getting too bearish on a pullback in growth. Doesn't mean it's going to be negative. It just means it's going to slowing. And oh, by the way, that's pretty normal.
Yeah, I mean, it's obviously pretty hard to have an outright economic downturn when you still got federal deficit 6% of GDP and you still have companies spending so heavily, Abby. I wonder how you're talking to clients about how they should set their expectations for investment returns from here, right? I mean, it is, as an entry point, it's obviously, you know, you've already seen some good stuff priced in. Valuations aren't necessarily all that attractive, but valuations tend not to bite, really, when you have the economy hanging in there, earnings growing, and all the rest.
Yeah, and I think the conversation on the economy is a little bit, well, obviously we don't even have any data at the moment. We're going to get a lot of information, I think, from the banks. Like, that's what we're going to be thinking about. Like, what's our alternative source of consumer data? And that's going to come from the banks. But you know, I think for the most part, consumer spending is actually fine. It's between 2 to 3%. What's been the question mark is what's happening with the labor market. And that's really difficult when you have all of these cross-firings in terms of immigration, right? It's very difficult to underpin that. But when you're thinking about the market going forward, it does come back to the, like, what's happening with productivity, right? Because that's from the margin profile, what's going to get it going. And again, that's going to come down to technology and implementing technology in a productive way that gets companies to be able to grow their revenues and keep their costs contained. But again, also going back to, like, it's really important that these companies now in the S&P 500 can immediately expense, like, CapEx and R&D. That's huge in terms of innovation and spending from these companies, which has, CapEx has generally been on the AI side. So that broadening out in terms of CapEx will be important. But I think the way that we get a more constructive outlook is you have a higher multiple for longer, which feels somewhat uncomfortable, but also higher earnings growth. Right now, we're at 11% earnings growth for 2026. The street's at like 13 to 14%. So it's definitely doable.
And Malcolm, you mentioned a couple of those adjacent themes to AI, and it obviously makes sense. There's a lot of money in motion. A lot of companies are going to be getting a piece of this for a while to come. I just wonder about, the way the market gets overexcited about certain things. Oklo today is up 18, 19%. It's up 700% this year. There's a lot of these businesses that are, they're positioned eventually to kind of serve the AI ecosystem by way of energy, but they're just not there yet. The rare earth metals are flying today because of the China stuff, and they don't have any real production to come through. So I guess what I'm asking is, are investors so overeager to play this trend that, we're kind of creating extremes and a little bit of distortion within the market?
Yeah, I completely agree with the spirit of the question. I think that investors have definitely tried to find the next NVIDIA, the next Broadcom, the next everything else in an attempt to sort of replicate what we've seen in those names so far this year. And I think to your point, the real opportunity still lies in those companies that more than likely have the capital to actually invest in developing this technology. So NVIDIA, for example, has a free cash flow problem. It has to spend the dollars that it's spending investing in its next customer simply because the free cash flow that it throws off, because it's become so productive. I think $4 million per head now is what their revenue numbers track out to. So I think a company like that and one similar to it have to spend these dollars in this way. But you think about the smaller companies that haven't really started to turn a profit and haven't even shown a path to profitability yet that investors are starting to glom onto. It's really just an attempt to find the next ... And that's probably the first place that starts to show cracks when the AI bubble does start to let that air out and burst.